Hi again everyone, I hope you're all doing really well. I just thought I might do something a little bit different with this video and talk a little bit about part of my trading strategy, that being how I approach my short-term or day trading elements of my activities. What I aim to do with this video is to introduce you to 3 of my favorite analysis tools, which I use while trading to identify good potential buying and selling opportunities. While there are many indicators out there that can be used as tools for trading, I particularly like these 3. However, just because I use these 3 does not mean I always time my trading right, but I do believe they help me to make more informed decisions when I do trade. 2 of these tools can also be quite useful for understanding medium to longer term movements in stocks, as the principles they employ go beyond short term. Personally, I have been trading for a few years now and have found that the more I have learned and traded, the better I have become at finding the right buy and sell moments, and fine-tuning my use of these tools has really helped me get better at that. Like all my content on here, this is not financial advice and just a reflection on my own preferences. Alright, let's look at these 3 tools. Just as a basic ground rule, when I am trading, I will use a 1-minute candlestick chart. However, for this video, I'm going to use a 2-minute candlestick chart, as I think it is a little bit better for illustrating the movements and trends that we are going to be looking for. I'm using the same active chart in all of these examples of one of my favorite stocks to trade, that being ASX listed buy now, pay later stock, ZIP. The principles would apply to basically any stock you want to trade. This is just one that I happen to be trading when I started making this video. So let's start looking at this first of the 3 tools. This first tool is what is called the Relative Strength Index, or RSI, which when used in my app appears along the bottom of the page. So this is it down here, this range of movement. This is used to indicate momentum in a stock by reflecting buying and selling conditions. It measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock, and can be used to provide bullish and bearish divergence signals. Typically, when using this indicator, when you have a score below 30, which is reflected by this bottom band here, you have entered into oversold conditions, and when the RSI has a score above 70, which is this top band here, it has entered into overbought conditions. The indicator uses a trend line, which is the squiggly line here, which can be used to see if a stock is generally trading in a bullish manner, i.e. scores tend to be higher, as you can see up here, or whether it is trending in a bearish manner when scores are typically lower. So you can see at the end of yesterday's trade and touch over here. At those same moments, you see sort of drops in the share price. Bullish divergence is found when new lows in prices are not matched by new lows in the RSI. Conversely, bearish divergence is found when new highs are not matched by new highs in the RSI. On this particular chart, there is not that good of an indication of either of these movements occurring. However, what it might look like is when we're looking at this period here, an example might be, so it's being overbought. However, the price, instead of going up like it is here, if it was actually moving more down like this, that would be a bearish divergence. It is important to keep in mind that it is only an indicator and should always be considered in light of broader market and economic news. But for me, it is really good at identifying buy opportunities, aka when the score falls below 30 or is significantly trending down. And of course, there is no sign of divergence, as this means there is a good indication that there could be a bounce in the stock price. So at the start of trade on Tuesday, we saw this big sell-off. There was a market-wide one, did dip, and this provided actually a very good buy opportunity. As you can see here, it shot straight up. And also you can see a few smaller little buy opportunities here. Here's one here that happened. So you can see that little movement up there. And again, this was almost a bit of a buy moment there. And again, you saw another little upward trend come there. Very interestingly, there was 2 low ones here where it kind of stayed sort of flat and it actually even went down. So you can see it doesn't always work out, the indicator. The next indicator I want to talk about is what is called the volume weighted average price, or VWAP, as it is often called for short, which is this blue line on the chart. This indicator provides the average price which the market has traded at through the day by combining both the price and volume of trade. I guess another way of looking at it is that you get an idea of what the average price paid per share at that point in time in the day has been. Like with all these indicators, this is not always the case, but a trading principle that can be used is that if the stock price moves above the VWAP line, it is likely to come back down. And conversely, when the stock price goes below the VWAP line, it should rise back up in a correcting fashion. Now the stock we're looking at here did have a particularly positive trading day. We don't see too many occasions of the stock price falling back down to the line, except fairly early on, just after 11, and over here as well. And it's only temporarily because it was quite a bullish day for the stock. But what you can see is that as the day goes on, the VWAP line and the general trend of the stock actually increasingly converges closer together. Problems with the volume weighted average price indicator is if the stock is having a volatile or heavily traded day, such as this one here, the indicator can become a little bit redundant as its movements are less likely to keep up with the movements of the stock price through the day. However, where the volume weighted average price indicator has a true strength is that it is one of the best indicators for understanding the trading trend for the day, as it moderates the fluctuations in price with the volume of trade. So you can see that generally looking through the day that things are heading in an upward direction. I know I shouldn't use a red to indicate positive. I will point out now that the VWAP or volume weighted average price indicator is the tool I was referring to in the opening of this video that I highlighted that is not good for understanding longer term movements in the stock. This is because it derives its average based only on that day's trade. It's not an overall average. You can get weighted moving averages for time frames like 20, 50, 100 days to do such a thing, which would be more useful for understanding longer term trends of the stock. The final indicator I want to look at is Bollinger Bands, and to me this is actually my most preferred trading tool. I generally leave it on for all of my charts. The Bollinger Bands establish a moving average, which is indicated by this black squiggly line, and it also sets out standard deviations from what the average is throughout the day, which is indicated by the two yellow lines forming the band. So you have that one here and one here. These deviations will typically be at 20% from the moving average. The standard deviations make the bands widen or narrow throughout the day according to volatility. So as you can see, more volatile trading happening in this section here. You get nice big wide bands. However, you do get these brief periods here where it is a little bit less volatile and the bands start to narrow. So these are more narrower periods. It doesn't mean things are going to stay that way forever. As the price moves become smaller, the bands become closer together and vice versa. The bands can provide support and resistance which can be used to establish a trading range. This is of course under the provision that nothing too drastic is happening to the price movements due to events such as company or macro news. If the price breaks and holds outside the upper or lower bands, this can be perceived as a precursor to a continued move in that direction. So we actually saw this, I'll use orange here, you actually see this occur at this point in the day. The bands adjust as it goes though. When the bands tighten, this indicates a period of declining volatility, we saw over here, which can often be perceived as a precursor to a breakout and a heightened volatility. So here you have a little bit of a breakout movement here where things drop off. A negative breakout, I suppose you'd say. My active strategy is to try and buy at a low volatility stage when the price touches the bottom band and sell at the average line. However, on an upward trading day, or trading period I should say, I will also look to buy from the average line, moving average, and sell at the upper band. Now when I add all three of these indicators together, it can make for a bit of a confusing picture. And the reason for this is simple. They are all telling you slightly different bits of information. Because they present different information, they may be giving you mixed signals about when is a good opportunity to buy or sell. When you add in the fact that you may be monitoring multiple stocks at a time, it can make for quite a paralyzing experience when trading due to an information overload. For this reason, I usually will only be using one or two of these indicators at a time when trading, and will set my objective or target prices for those trades accordingly. However, in saying that, when using all three, you will occasionally get moments when all three indicate the same buying or selling opportunities, which arguably better improves your chances of trading success. So very early on in trade, we have this indication here and over here, lower average, bottom of the Bollinger Band, and an oversold point in the RSI, and that indicated actually a really good opportunity to buy. And look what happened from there. The price just took off. Also, we can look here, we see overbought in the RSI, clearly above the moving average. And again, at the top of the band, we get a very good opportunity to sell. So if you bought there and sold there, you would have made a lot of money on that trade. You would have made a lot of money on that trade and would have actually been selling at the top of the day. Not that we would have known that just from these charts, but it just sort of shows that it can present an opportunity where there is good times to sell and also good times to buy. So the point is, when all three indicate the same sort of buying or selling moments, it arguably improves your chances of trading success. When it comes to trading and using indicators and tools, you need to know what you are looking for and try to work out what works best for you. These indicators in no way ensure trading success, but they at least help to make it a bit more of a mathematical exercise. Anyway guys, thanks for watching. I hope you found this interesting or useful. Do you use any of these indicators in your own trading, or do you have any others which you think are worth using as well? Let me know in the comments below. If you'd like to see more trading and investing videos like this or stock updates, I would encourage you to subscribe to the channel. I try to release something more or less every day. Until next time everyone, may the markets trade in your favor. Take care. Cheers.